A company purchased a machinery for rupees 5 lakh on 1st January 2005. The machinery is to be depreciated at 20% per annum on straight line method, that is original cost method. So the accounts are closed on 31st December each year. You are required to show machinery account and provision for depreciation account till 31st December 2006. Since the date is given to be 31st December 2006, it would be assumed that the accounts are closed on 31st December each year. And a point to note here is that we are required to show machinery and provision for depreciation. That means the depreciation would now be recorded as per provision for depreciation account method. Starting on 1st January 2005, this machine was purchased, that is to bank, for rupees 5 lakh. The entry would be machinery to bank. Now there is no other purchase or sale. So at the end of this year, depreciation would be charged. Just to recall, in case provision account is maintained, the journal entry is depreciation to provision. That means depreciation would now be recorded in provision for depreciation account. So on 31st December 2005, by depreciation, 20% of rupees 5 lakh, it comes to rupees 1 lakh. Just to recall again, in this method, depreciation is not charged in machinery account. It is not charged here. It is charged to provision for depreciation account. Now this is the last date of the year. So let us total it out and find the balances. That is on 31/12/2005, by balance carried down 5 lakh. In this case, the total here on the credit side is 1 lakh. So the closing balance will be on the debit side. To balance carried down 1 lakh. This marks the end of year 2005. Both these closing balances, that is balance in the machinery account and the closing balance in provision for depreciation account, would be brought down in the next year as opening balances. So this would be brought down on the debit side on 1106, that is 1st January 2006, to balance brought down 5 lakh, and this 1 lakh would be brought down as opening balance on 1st January as balance brought down 1 lakh. In year 2006, we have used this machine for whole 1 year, that is full 12 months. So again depreciation would be charged at 20% on 5 lakh. 5 lakh because it is a straight line method. So at the end of this year, that is on 31/12/2006, by depreciation account, 20% of 5 lakh, it comes to rupees 1 lakh. Again, since it is last date, let us find the balances at the end of the year. 2 lakh is the total. On 31st December 2006, it would be to balance carried down 2 lakhs. Same thing for machinery account. Here the total is 5 lakh, and at the end of the year, that is 31/12/2006, it would be by balance carried down 5 lakh. Now students, we were required to prepare till 31st December 2006 only, but again we must bring down these balances in the beginning of the next year and leave it there. To balance brought down 5 lakh for machinery and 2 lakh for provision, that is by balance brought down 2 lakh here. So just to recall, in this method depreciation is not charged in machinery account, rather it is charged to provision account, and the balance of the machine remains same. There is no deduction. At the most, there can be an addition if there is a new machinery that is purchased, and all the depreciation would be charged to provision for depreciation account.